Today's episode is brought to you by Mazars.
SoundCartel.
After saying they wouldn't do it until 2024, the Reserve Bank of Australia increased the cash rate in May from 0.1% to 0.35%, a rise of 25 basis points. Still low by historical standards, but is it just the start of more increases? And what does it all mean for investors? From SoundCartel, this is Business Essentials Daily. I'm Peter Letts, filling in for Nicole Goodman. Inflation rates or market volatility will always dominate the headlines, but for the long-term savvy investor, they're merely distractions. So says investment advisor and commentator Greg Keady of APW Partners, who provides historical analysis of interest rates and the impact they have on our investments. But first, Chris Ashmore asks Greg why the Reserve Bank decided on its recent hike of the official cash rate.
Well, the Reserve Bank's role to a large extent is to regulate the economy and ensure that it doesn't overheat and it doesn't cool down. It stays, I guess, the Goldilocks sort of lukewarm, and that things progress, at a steady pace through time.
So does that mean we're likely to see more hikes?
Most definitely. We've only seen a very modest increase from 0.1 to 0.35. We've got an inflation rate annualised. If you annualise the March quarter at 2% of an 8% figure, it's not safe to do that entirely. It's a bit simple to do that, but 5% in the last 12 months, if we continue to see what we've seen in the last quarter, it'll be higher than that in the next quarter on an annualised basis. So, it's most likely, and the bond markets have been pricing in interest rates in Australia adjusting to 2% by the end of the year. So, that's a pretty rapid increase. So when the cash rate moves, essentially the interbank lending rate also moves. In other words, when the banks are lending to each other and borrowing off other entities and so forth. And that filters into, home loans, credit card interest rates, business loans, across the spectrum. So, it's a very sensitive item essentially, and as much as a 1% increase might not feel like a lot, when you're paying a mortgage of 2.5% or 3%, 1% increase proportionally is a very substantial increase. So, there's certainly the central bank, and because of the extent of home lending that we have here at the household level relative to, say, the US and other developed countries, there's some probably greater sensitivity with the RBA, progressing a bit slower than perhaps others would perhaps have been. There's been a lot of judgment of the RBA being slow, and they're certainly being very cautious to ensure that things don't get out of hand.
Well, if we can dig into that, from your perspective, how does the rate increase impact investments?
Yeah, it's pretty pivotal and very central. So it has certainly, if you think about when you're investing and having an expected rate of return, most of us want to actually get the highest possible rate of return for the least amount of risk. And not all of us have tolerance towards, equity type risk or share market type risk. And not all of us even want to necessarily hold property because of the responsibilities that might go with that. So there's a lot of people, that are very much reliant on interest rates from lending their money to banks, governments and other lenders and so forth. So when inflation picks up, interest rates follow suit. And that has certainly been the case historically. They're very closely linked insofar as the impact of higher inflation, sustainably higher inflation, is inevitably higher interest rates. And short-term monies, short-term deposits and so forth, for example, in certain banks have actually jumped to 12-month rates at 2.5%. And 2-year rates at 3.5%. That's not the big four banks. You've got to go into the second-tier banks, the likes of Macquarie, for example, that have those rates on offer right now. So it's a very, very rapid increase that we've seen in the interest rate cycle, essentially. And the banks will ultimately shift when it suits them, obviously not at the moment. But insofar as, the impact on other markets, so when interest rates move back to a figure, above inflation, if you have $1 million, for example, and you need $30,000 a year to live, then a 3% rate of return is a very simple way to think about it. You've got inflation, tax and costs to bear, and if you're trying to preserve that wealth essentially, and you can get that by lending to a AA credit rated bank, then you may not necessarily feel the need to take the risk of owning shares or owning property. So as interest rates actually increase, people that think in nominal terms feel more comfortable lending their money to a bank. But it's important to think in real terms, which is really if I'm earning $1 but I'm spending $1.50, I've got a problem. So as inflation increases, the real rate of return, particularly if inflation increases more than the interest rates, and which is what we've had, So the real rate of return of interest at this stage essentially is negative, significantly negative. And unless we see the interest rates come up above the inflation rate, we'll stay that way for a little while.
How volatile is the market at the moment, and are all investments in a bit of a funk?
So volatility, there's different measures of volatility. There is actually in the share markets, there are what we refer to as the volatility index, which is a forecast of the expected future prices and so forth, from this point forward. And we have volatility that certainly not the levels that we saw in February, March of 2020, but at levels that are substantially higher than normal. I guess the sheer volume of trade in the share market in a positive and negative form in the same 24-hour cycle has been quite extraordinary to see. To see 5%, 3%, 4% movements essentially over the course of the last month or so on a daily basis has actually not been uncommon. We've seen the largest companies in the world essentially by earnings and profit and value fall very significantly. So the likes of Apple and Microsoft, Google, for instance, are down from their peaks of the beginning of the year and late last year of 24, 25%. Amazon, that obviously thrived during the course of, the lockdowns and the COVID period, essentially down 42, 43%. Tesla down by a similar order. So very substantial, implications. But by the same token, those companies have been trading at prices that are extraordinarily high, well and truly above long-term average prices, for good reason, because their earnings are growing, their profits are growing. But there's basically been a very significant shift broadly and globally. And I guess the focus has shifted away from owning companies at any price or paying any price for a future dollar of profit and earnings to be focused more on those companies essentially that represent value, where the price you're paying is actually at a fair value, if not below fair value, for the assets and the earnings of those companies. So value companies essentially whose share prices or their market value is typically close to or less, generally less than their book value, the value of their assets, that sector essentially has held up incredibly well and been quite positive. So how you diversify across the share market is really important. It's not just a matter of focusing on different industries. You really need to pay close attention as to literally how expensive are my companies or how cheap are my companies and how will they fare when essentially there's a sell-off for concerns essentially of overvaluations and the market being overheated, which is what we've seen over the course of the last 6 months, is an attitudinal shift towards leaving company prices and selling down to realise profits from prices that have been overshot potentially into companies and segments of markets where there's greater value represented. So that value growth consideration when you're investing is a really important one. Growth companies have actually really outperformed value for the last 10 years or so, but we're moving into a cycle where it's most likely, highly probable that value will outperform growth. So that's the language that not all investors necessarily will be familiar with, but it's something they should learn more about.
Well, before we go, Greg, how should listeners approach investing now?
Chris, one of the, the doyens of modern finance, if you like, one of the greatest investors in modern history is Warren Buffett. And Warren's a college professor, Benjamin Graham, responsible for a book entitled Security Analysis. It was his birthday just a couple of days ago. I think he would have been 130 or thereabouts. And he has, written at length about the importance of, being a good investor, not just necessarily finding good investments. Today we think about that as behavioural finance in terms of how we respond to shocks and new information, etc. and so forth. And one of the things, without necessarily quoting him verbatim, that really he focuses on essentially is the share price today. For a long-term investor, for a broadly diversified, the share price today is important, but really becomes a big distraction for many. And for most investors, they really should not so much, it's a bit too flippant to say, ignore what's taking place, but be very cautious and careful in reacting to the fear that naturally accompanies price movement. We're seeing that happening now. There's a lot of significant sell down in certain segments of markets, which is creating a lot of value at the same time. So that's always the opportunity, of the downside, is that it presents an even higher expected return from those entering markets. So be careful that, that one, make sure that you're broadly diversified, two, understand what you're investing in, and three, be careful not to let your emotions get the better of you.
That was Greg Keady, Executive Director and Principal Advisor of APW Partners. Business Essentials Daily is a SoundCartel podcast. Producers are Nick Schulberger, Chris Ashmore, Jeff Waters and Nicole Goodman. Technical production by Belinda Trimboli. I'm Peter Letts. Thanks for listening. We'll bring you more B Daily next week.
SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.